Imagine two children, same IQ, same family, same opportunities. 30 years later, one becomes a millionaire, the other struggles to pay the bills. Why? Scientists spent more than 30 years trying to answer that exact question, and what they discovered completely changed the way Warren Buffett thinks about money, and it might change the way you think about it too. In a 1989 interview with Outstanding Investor Digest, American investor Walter Schloss shared a fascinating story about his longtime friend, the legendary investor Warren Buffett. Schloss said that one day, Buffett was playing golf at Pebble Beach with his friend Charlie Munger, Jack Byrne, and another player. During the game, one of them turned to Buffett and said, "How about a bet? If you can sink the ball into any one of the 18 holes with a hole-in-one, I'll give you $10,000. But if you miss, you only have to pay me $10. Most people in Buffett's position would probably accept that bet. After all, the potential loss is tiny compared to the potential reward. And for someone considered one of the richest people in the world, losing $10 would be completely insignificant. But that's not what Buffett did. According to Schloss, Buffett immediately refused and said, "No, I'm not betting." The others asked him, "Why not? The most you can possibly lose is just $10, while you have a chance to win $10,000. Buffett's response became one of his most famous quotes: "If you are not disciplined in small things, you won't be disciplined in big things." That single sentence perfectly reflects Buffett's investment philosophy throughout his life. It's also one of the biggest reasons behind the enormous fortune he built and the remarkable career that led many people to consider him one of the greatest investors in history. When Buffett turned down the bet, he wasn't focused on how insignificant the potential loss was, nor on the fact that the possible reward was 10,000 times greater than what he could lose. Instead, he focused on one simple question: what are the actual odds of making a hole-in-one? Since he knew the probability was extremely small, he simply refused to make the bet. He wasn't willing to throw money away, even if that money meant almost nothing to him. Even though it was only $10, accepting the bet would have gone against the discipline that his long and successful career had taught him, a quality he believed was far more important than intelligence. Many people fail to build wealth not because they're unintelligent, but because they lack a skill that's even more important than intelligence: self-discipline and emotional control. Impulsiveness and the urge to take action simply for the sake of doing something have destroyed countless fortunes. They've also prevented many people from building wealth in the first place, or even improving their financial situation. But why does that happen? Nowhere is this more obvious than in the stock market, and that's exactly what we'll explore together in today's episode. I'm Kero, and welcome to a brand new episode of Kerovox. In January 2011, British-American psychologist Terrie Moffitt, along with a team of researchers, published what is considered one of the most important and influential psychology studies of the past few decades. In this study, Moffitt and her colleagues examined the behavior of 1,037 children who were born between April 1972 and March 1973 in Dunedin, New Zealand. Their goal was to answer one very important question: does a child's ability to control themselves have anything to do with their health and financial success later in life? To answer a question like that accurately, and without relying on guesswork, you have to follow those children throughout their lives. And that's exactly what Moffitt's team did. The study began in 1975, when the children were around 2 to 3 years old, and continued until they reached the age of 32. Over those many years, the researchers tracked the participants through 11 different stages of their lives, measuring both their physical health and financial well-being until the study was completed. At the same time, they measured each child's level of self-control at the ages of 3, 5, 7, 9, and 11, evaluating factors such as hyperactivity, attention, impulsiveness, aggression, and several other behavioral traits. Nearly 35 years after the study began, Moffitt and her team published their findings. Out of the original participants, 1,014 who were still alive remained involved in the study. The results were remarkably interesting. The children who showed higher levels of self-control during the first 10 years of their lives achieved greater success as adults, even after accounting for factors like intelligence, social class, and family background. In simple terms, the study suggests that you could have two children with the same level of intelligence, the same social background, and very similar family circumstances. Yet years later, one ends up wealthier and healthier than the other simply because they had stronger self-control as a child. According to the study, children with greater self-control are less likely to abuse drugs, develop criminal records, or experience serious financial problems later in life. But why? The answer is simple. Self-control helps people resist the temptation of instant gratification. It allows them to keep their impulses in check and manage their emotions, or at least control how they express them. And perhaps one of the greatest tests of self-control in life is money. On one hand, money constantly triggers emotions like greed, hope, panic, and anger. On the other hand, the way a person handles money, whether they invest it or spend it, plays a major role in determining their financial success. More than 10 years ago, on the evening of November 8, 2016, Donald Trump was declared the winner of the U.S. presidential election. The result shocked not only Americans, but the entire world. The very next day, large numbers of investors in the U.S. stock market rushed to reduce or completely sell their stock holdings. They quickly moved their money into bonds, commodities, or simply held it as cash. Why? Because they believed Trump's victory marked the beginning of a major decline, and they wanted to jump off the ship before it sank. Speaking about that period, Rebecca Kennedy, the founder and president of Kennedy Financial Planning, said that the day after the election, many of her clients called her feeling angry and terrified by the results. They demanded that she liquidate all of their investments and move everything into cash immediately. Trying to calm them down, Kennedy told her clients, "I'm not claiming to know what the Trump administration has in store for us, but I can tell you one thing with confidence. The investment horizon of your portfolios will most likely be much longer than Trump's time in office." In other words, what she was telling them was, calm down, stay in control, don't rush. You're long-term investors, not short-term traders who panic at the first sign of trouble. Therefore, logic and common sense tell us that as long as the fundamentals of the companies you're invested in haven't changed, the best strategy in a situation like this is to stay the course and keep your emotions under control, not give in to fear and panic. Most people who ignored that advice, or did the exact opposite, ended up deeply regretting it. Just consider this: during Trump's first year in office, the Dow Jones Industrial Average rose by 31%, while the S&P 500 gained around 23% over the same period. The biggest winner during that time wasn't the investor who kept buying and selling. It was the investor who did nothing. The one who simply sat still, didn't sell, didn't buy, and didn't make any changes to their portfolio. Staying calm, doing nothing, and keeping your emotions under control when the market is consumed by fear is not an easy skill. Many people simply can't sit still. They feel like they have to do something, not because it's the right move, but simply because they feel the need to act. That brings us to one of the best-known concepts in behavioral economics: action bias. Action bias is our natural tendency to take action instead of waiting patiently, even when that action is less effective, or even more harmful, than doing nothing at all. More often than not, the real motivation behind that behavior is psychological. People simply want to relieve the stress and anxiety that come with uncertainty. Many people lose money, especially in a difficult market like the stock market, because they can't control their emotions, particularly during periods of fear. Others make fortunes because, after carefully selecting their stocks and building their portfolios, they simply leave them alone, regardless of how the market moves. More than 100 years ago, in 1923, American journalist Edwin Lefebvre published his famous book Reminiscences of a Stock Operator, which captures much of the investment philosophy of the man widely considered the greatest stock trader in American history, Jesse Livermore. In the book, a fictional character representing Livermore says, "After spending many years on Wall Street, making and losing millions of dollars, I can tell you this: it was never my thinking or my intelligence that made me a fortune. The secret was my ability to be patient and stay in the market. It's not difficult to be right. I've known many people who were right, who picked the best stocks and bought or sold them at exactly the right prices to make enormous profits. Yet they made very little money because they lacked the ability to stay patient and hold their positions. Many people lose money in the market not because they're foolish or unintelligent. They defeat themselves. The market doesn't beat them, they beat themselves. Because despite their intelligence, they simply can't stay patient or keep their emotions under control." Warren Buffett expressed the very same idea in different words during Berkshire Hathaway's 2004 annual shareholders meeting. During the meeting, a shareholder named Oliver Grassa took the microphone and said, "My name is Oliver Grassa, and I'm from Vienna. I've studied economics and read around 40 books on investing. My dream is to become a successful investor like the two of you. When you were younger and managing much smaller amounts of money, how many reports or publications did you read to find good investment ideas that eventually led to your success?" In response, Buffett told him, "Temperament is more important." He then continued, "If you can't control yourself or your emotions, it doesn't matter how intelligent you are, you'll run into disaster." Charlie and I have seen it happen over and over again in the market. He concluded by saying, "This investment business doesn't require extraordinary intelligence. What it requires is extraordinary discipline, and that really shouldn't be so difficult. But when I look around the world, it sometimes seems like that is actually very difficult." That's Buffett's point. And let me explain why so many investors struggle to stay disciplined, especially during periods of extreme optimism or extreme pessimism. By its very nature, the stock market is a noisy, volatile environment filled with an endless stream of information. Investors are expected to steer their portfolios through this environment for years, sometimes even decades. The biggest challenge they face is maintaining discipline in the face of the constant flood of news that never stops. If you pay too much attention to it, you'll constantly feel like you need to make an urgent decision to either buy or sell, especially when you see a large portion of the market reacting the same way. Many investors end up following the crowd, making buying and selling decisions they aren't even fully convinced about, simply because everyone else seems to be moving in the same direction. They follow out of fear of missing out or missing their chance. In behavioral finance, this phenomenon is explained by what's known as regret theory. The theory explains why investors often find it easier to follow the crowd, even when they don't truly believe it's the right decision. The reason is simple. If they lose money, at least they won't be losing alone. A large part of the market will have lost alongside them. For many people, that's psychologically easier than controlling their emotions, sticking to their convictions, and standing by their decisions even when the entire market is moving in the opposite direction. By the way, when we talk about self-discipline in stock market investing, we don't mean being stubborn, rigid, or unwilling to adapt. That's not the point at all. What we mean is trying, as much as possible, to remove emotion from your investment decisions. For example, if my analysis tells me that entering the market right now is too risky, or that a particular company has weak fundamentals, then I simply won't buy that stock even if I see everyone else rushing in and making money every single day. And that's a difficult decision for investors to make, whether they're beginners or seasoned professionals. In 2000, American investor Stanley Druckenmiller was managing the quantum fund for billionaire investor George Soros. Druckenmiller was a brilliant investor and one of the most successful hedge fund managers in America. Yet even he made a simple mistake, one he should have known better than to make. Here's what happened. In January 2000, during the massive rally in U.S. technology stocks, Druckenmiller became convinced that prices had risen to irrational levels. He believed the market was in a bubble, and that the bubble would soon burst, causing devastating losses for investors in technology companies. Based on that belief, he walked into Soros's office and said, "I'm selling all of our technology stocks, every single one. We'll move everything into cash and wait on the sidelines for the next opportunity." And that's exactly what they did. The fund sold all of its technology holdings and locked in enormous profits. But after they exited, the market kept climbing. Technology stocks continued to soar. Watching from the sidelines, Druckenmiller couldn't sit still. Then came the moment he would later regret. As he watched other investors continue making incredible gains every day, greed got the better of him. He decided to jump back into the market just a few weeks after getting out. It was March 2000. His plan was simple: make a little more money before the bubble burst, then get out again. So he re-entered the market and bought $6 billion worth of technology stocks. The problem? He barely had time to get back in. Just 1 hour after making those purchases, the market turned. The bubble burst. Within just 6 weeks, he had lost half of that investment, around $3 billion. Years later, in 2015, Druckenmiller was asked what he had learned from that mistake. His answer was revealing. "I didn't learn anything. I already knew I shouldn't have made that investment. I was simply emotionally exhausted at the time and couldn't control myself. So maybe what I learned was not to do it again, but honestly, I knew that from the beginning." Druckenmiller's words highlight a very important point. Knowing the right thing to do is one thing. Actually doing it is something completely different. Almost every investor knows that making emotional decisions and losing self-control can be extremely dangerous, especially in a market like the stock market. Yet despite knowing that, most investors still fall into that trap. And that's exactly why they lose money and fail to achieve lasting success in the market. That brings us to today's question. Do you invest in the stock market in your country? If you do, how successful has your experience been so far? And if there's a specific topic about the stock market or investing in general that you'd like us to cover in more depth, let me know. I'll be reading all of your comments. Finally, if you enjoyed today's episode and would like to see more, don't forget to subscribe to the channel, and I'll see you in the next one.